Whether you're trading Bitcoin or meme coins, the charts are always trying to tell you something. Those ups and downs aren't random. They form patterns pointing toward the market's next move. Welcome to BingX Crypto Trading 101. In this episode, we'll help you spot the most common crypto chart patterns and how you can use them to find potential entries and exits. Ready? Let's get into it. First off, what are chart patterns? Chart patterns are shapes formed by price movements over time. They reveal the constant tug of war between buyers and sellers. When you learn to recognize these patterns, you can start to read what the market might do next. Is the market taking a breather before another big move, or is it showing signs of exhaustion and ready to reverse? Understanding support and resistance. Before we dive into the patterns, let's cover two key ideas: support and resistance. They are the foundation of every chart pattern. Support is the level where buying is strong enough to stop prices from falling. Resistance is where selling is strong enough to stop prices from rising. In most charts, you'll see price bounce between these two levels, like a ball bouncing between the floor and the ceiling, until one side finally breaks. That's when a breakout or breakdown happens, setting the stage for the next big move. To go deeper, check out our tutorial on mastering trend lines, link in the description below. Top chart patterns every crypto trader should know. Now that we've covered the basics, let's talk about the patterns themselves. They usually fall into two main types: continuation patterns, which suggest the trend might continue, and reversal patterns, which signal the trend might end. Here are some of the most common ones you'll see. Head and shoulders patterns. Let's start with one of the most well-known reversal patterns: head and shoulders. It's made up of three peaks, two smaller ones on the sides, the shoulders, and one taller one in the middle, the head. The pattern usually forms after an uptrend and signals that buyers are losing momentum. When price breaks down below the neckline or the support level connecting the lows between the shoulders, it often marks the start of a bearish reversal. There's also the inverse head and shoulders, which appears after a downtrend. You'll see three dips, two smaller ones on the side and one deeper one in the middle. When price breaks above the neckline, it often confirms a bullish reversal. Next up, double top and double bottom, two of the easiest reversal patterns to spot. A double top looks like an M, where prices hit the same resistance twice, fails to break higher, and then drops. Flip it and you get a double bottom, shaped like a W. Here, price bounces off the same support levels twice, showing sellers running out of steam. A break through the neckline confirms the reversal. Number 3, triangle patterns. A triangle forms when price bounces between two trend lines that slowly converge. You'll see this tightening action on the chart, and there are three main types to know. An ascending triangle has a flat top and a rising bottom. Buyers are stepping in at higher and higher prices, showing strength, and price usually breaks to the upside. A descending triangle is the opposite. The bottom is flat, but the top keeps dropping. Sellers are pushing harder each time, and that usually leads to a breakout down. And then there's the symmetrical triangle, where both sides are closing in. It's the market saying, I can't decide yet, but the energy's building, and when it breaks, it can go either way. Number 4, flags and pennants patterns. Flags and pennants are short pauses in strong trends. After a sharp move, price takes a quick break and forms a small flag or pennant shape. The big move before it looks like a straight line. That's the flagpole. Once price breaks out of the consolidation, it usually keeps moving in the same direction as the flagpole. These setups form fast, making them great for spotting short-term momentum trades. Number 5, wedge patterns. Finally, let's look at wedges, which often signal a shift in trend. A falling wedge slopes downward with both lines pointing lower. It shows sellers are losing control. When price breaks upwards, it often signals a bullish reversal. A rising wedge, however, is the opposite. Both lines slope upwards, showing that buyers are running out of momentum. When price breaks down from that pattern, it usually signals a bearish reversal. How to use chart pattern breakouts to time your entry and exit. Let's use a 1-hour Bitcoin price chart on BingX as an example. After Bitcoin fell from around 108,400, price began consolidating near 104,000, forming lower highs and higher lows. If you plot two trend lines, one across the lower highs and one across the higher lows, they'll converge into a symmetrical triangle. It shows buyers and sellers are battling for control as volatility tightens. Eventually, Bitcoin broke above the upper trend line around 105,800 to 106,000, confirmed by a strong candle close and rising volume. To estimate the move, measure the height of the triangle, about 4,400, and add it to the breakout level near 105,800, giving a target around 110,200. In this case, Bitcoin topped out near 108,500, just below resistance. And now, here are 5 tips for using chart patterns. Chart patterns can be powerful, but only when you use them with confirmation, context, and proper risk management. Here are 5 tips to apply them like a pro. First, confirm the pattern. A pattern means nothing without confirmation. In our Bitcoin breakout example, volume climbed as price broke the triangle's upper line, a clear sign of real buyer interest. RSI crossing above 50 showed momentum building, and a bullish MACD crossover confirmed it. Together, those signals helped filter out the fake breakouts that happen in low volume markets. Second, know when the pattern is invalid. Every pattern has a point where it becomes invalid. If price breaks the key level that defines it, like dropping below support in a triangle, it's your cue to move on and look for another setup. Third, trade with context. Patterns don't exist in isolation. Make sure your setup aligns with the bigger trend and market sentiment. Higher timeframe charts like 4-hour or daily are usually more reliable. Shorter ones like 15-minute or 1 hour give quicker signals but more noise. Always zoom out before you zoom in. Fourth, manage your risk. Even perfect setups fail sometimes. The trick is to manage your risk so one bad trade doesn't wipe you out. Avoid over-leveraging, size positions wisely, and plan your exits, such as taking partial profits near resistance and trail your stop loss as price moves in your favor. Good traders don't just focus on entries, they master their exits too. Fifth, cross-check with BingX AI. Once you've done your own analysis, use BingX AI for a second opinion. It helps you analyze any chart, trading volume, and indicators like RSI and MACD to see if the data supports your idea. If your setup aligns with the AI's insights, you've got extra confidence. If not, it's a good idea to step back and reassess before entering the trade. Chart patterns won't predict the future, but they help you make sense of it. Combine them with good risk management, patience, and discipline, and you'll start trading with more confidence and less emotion. Keep learning, keep practicing, and you'll build the kind of consistency that separates smart traders from the lucky ones. If you find this video helpful, make sure you subscribe for more tutorials just like this one. Tell us in the comments what you'll like to learn next, and as always, trade safe and stay sharp.